Good evening and welcome to the weekend edition. My name is Peter Rezicek from ShadowTrader.net, and the word for this week is just wow. And I mean simply wow. We had crazy reversal this week out of nowhere after some downward action. We are going to definitely get into those charts, where we came from, where we are, and where I think we might be going. I'm also going to be analyzing a couple of losing trades that I had this week in that whipsaw action. And we're going to wrap up the program today with an interview with Michael Guyad from the Lead Lag Report, who's going to give us the fundamental take pre-FOMC next week, Wednesday. Without further ado, let's get into it. Time now for the technical take. I call it what's really going on, because it is really what's going on. The actual price action on the charts is really what matters, not what's happening fundamentally or what you may be hearing on television or any sort of thing that's underpinning the market. Is really all about where is price and what it is doing in the past, in the present, and where we think it's going in the future. So let's head over to the charts. Look at the S&P 500 daily here. The name of the week, as I was saying in the introduction, is just wow, because this was such a huge whipsaw that kind of came out of nowhere. We had this bearish action here that took the market down here. Notice this is a 50% fib level right here. So this level right here is about the midpoint of the rally that's starting down here. And we came close on this move. But what really was the surprising factor this week is that a couple of days ago, midweek, notice where we came down on this candle. We literally tested this August 6th low, which is the big body candle. So obviously at the low of that session, everybody's thinking that it's got to be lower at that point, myself included. And yet we just turn around from there, retrace the whole candle, and obviously we're off to the races. In the S&P, we did get a pinch to the downside as well on the 821. I talk about that a lot, where notice these green dots here, that's your 8, and that darker solid green line is your 21. And you actually got the pinch below. Remember, we've talked about this before, talking about how if a market comes down and you don't get a pinch, that's a tell that it may reverse. But in this case, we got the pinch. I would have been a little bit more doubtful of the reversal had we not gotten the pinch. Or I should say I'd been more doubtful of the move down that we would get follow through had we not gotten the pinch. But you can see clearly right here, the pinch was in effect, right? I mean, that's literally this part right here. If we zoom in right there, you can see the 8 going through the 21, and yet we got the reversal anywhere, just kind of out of nowhere. I shouldn't say out of nowhere, because it was at a technical low, but it just doesn't make much sense to me, given that we retraced the bounce move off of an expansion of range to the downside. So that being said, we then closed the bar above the 8 and the 21, and the next couple of days have been rally days. This is actually putting us very, very close to the all-time high. Now, there's only 3 trading days, call it like 2.5 trading days before the FOMC, which is going to be on Wednesday. That's obviously going to be the main event. The market could go in either direction. But notice that we're almost very close to the top of the balance area now. I would think at this point we do go up to the balance area. I had a question today in Weekly Options Advisory where somebody was asking me, is this actually a look below and fail? And should we assume that because of the way that a look below and fail works, when you fall out of balance to the downside and you come back into balance, traditionally you rotate back to the high end of balance? The question from the subscriber was, should we expect a rotation back to the high end of balance? I think that we're going to be getting that rotation. We're almost there anyway. But just to be clear, this is generally not how balance breakdowns work. It's not the same thing as a classic look below and fail, because a classic look below and fail is one that happens on one day or at most one day later. So a classic look below and fail would be like this, where you have a balance area and you're trading in, right? And you go down here and you break out of balance, but on the same day you come back up. Right there where you come back into balance, the rule of thumb is that you're going to rotate back to the opposing end of balance. If anything, this is a lot trickier in that you had many days below balance. You have your balance area here, you broke out, and now you just happen to be going back into it. So just in case if you're wondering what this price action means in the context of that balance area, it doesn't mean a whole lot. I think we're just going to be rolling right up to the top of it. And really your focus has to be here on the all-time high. Now, I would not be surprised if we actually do get there before the Fed. Obviously, buyers are in control. People are short. They got themselves short as we broke out of balance. And you also have the other catalyst of the fact that if we do move up to the top end of balance, there may still be some late to the party longs there who think they're buying the breakout of balance. I don't know. Like, you know, I always think to myself that there always are many, many laggards in the market who are acting too late or who may just be holding positions through pullbacks, and they're seeing that move to the high end of balance as a breakout spot area. So it could be that. So I would not be surprised at all if coming into next week, the trajectory is to here, and we'll see if we get to an all-time high or maybe even higher. And that's basically the situation of where we are now pre-Fed, right? We know what has already happened, and we talked a little bit about what potentially could happen early next week coming into the Fed in terms of a float to that top of that bounce area and perhaps a new all-time high. So let's go over here to the other screen and take a look at what are the odds of a Fed cut going into Wednesday, because obviously this is the first time that the FOMC has been moving rates or making some move on rates in a long time. Obviously they are going to cut, but we don't know exactly how much. This was really noteworthy to me, and it kind of jumped out at me. As the week progressed into the end of the week, I took this snapshot on Friday afternoon. This is the CME Fed Watch tool, which gives us the FOMC odds, or I should say rather the odds of what the cut is going to be according to the Fed funds futures. And now look at how even they are. You're talking 53% to 47%. Between a 25 basis point cut and a 50 basis point cut. And again, this was 80-20 earlier in the week. So is the Fed signaling that there's a little bit of fear on their part and they need to be more aggressive? I don't know. But regardless, notice that there is now 50-50, then we might actually get a 50 basis point cut. How is that going to affect the markets? Let's go back and take a look at the charts. I don't know, obviously, so all we can do is look at different frameworks and we can talk about how the market got to where it was, which potentially sets up how it may act moving forward. So the first thing I want to mention is that as you're looking here, and I don't really have anything graphical to show you, but notice that once that was retraced 100%, the market is obviously off to the races to the upside. Again, I don't have anything graphical to show you, but if you are watching the markets over the last 3 sessions, when we moved to here and then Thursday and Friday, you would agree that it was extremely forced action. There is action that is longer-term traders buying the market, and there is action that is traders forced into it because they have no choice because it's only going in that direction, or they are covering shorts. And this is exactly what was happening on those 2 days. You had lots of surges higher, you had very small liquidation breaks lower, market never really did anything in the downside, and it just kept surging and pushing to the upside. The reason I mention this is specific because if there is a catalyst move on the Fed, wherever it comes from on the chart, understand that that could turn into a larger move lower, if only because the price action that led up to it, okay, is on poor structure. It's on shaky footing. It's not the type of buying, at least from my experience, what I was witnessing this week, it is not the type of buying that is going to hold up to stronger selling in the face of it. Those are shorter term traders who are there, and it didn't feel like there was anybody really supporting the bid, letting the market come in and sort of building equity positions long. This is all that happened, was just a lot of forced action to the upside. So we want to just keep that in mind. Now, one of the things that I'm going to be looking for next week in terms of the Fed, and depending on where we are in relation to the balance area high and the all-time high, is the fact that I want to see if early next week we actually move up here, and I want to keep this all-time high here at the 56.75 area as my most important reference. And I say that specifically for this because we want to think about what are the potential scenarios on the Fed. I do not think that the scenario here is going to be to hold pat and go sideways. This is a big deal. We haven't cut rates in a while, and it is going to be either a potential signal of recession or not, right? That hasn't fully come into fruition yet, but the more aggressive they are, that's what the market's going to be thinking. So what I think we need to be doing next week is focusing on that all-time high. Once the news is out, if we're above it, question is, do we hold above it or not? Or do we come back into range? I think that any action that is back inside of range is potentially a short, especially if we come back into this balance area, and even more especially, mark off where the low of the balance area is. So I want you to watch 55.75 after the Fed, because that's going to make at least this balance area here be overhead supply. And remember, the most important part of all this is the fact that the move that was up is on shaky footing. So I think if you start to retrace 25% of that move, 35, 40, 50% of the move, that matters, okay? I'll leave you with this. The simple fact is that larger moves in the market only happen, regardless of direction, could be up, could be down. Larger moves in the market happen because the stage is already set for it behind the scenes, okay? It's the underpinnings of what's happening, what type of inventory position of the players, and who those players are that sets it up. Everybody will blame the catalyst. So they will say, oh, the Fed cut rates too much and they're scared, or the labor number, labor is getting weaker, we're headed into recession. Okay, that will be the catalyst that everybody will think of, but understand that it will come down hard if there is a weak market leading up to it. And this is what I see as a very weak market. Okay, these are weak-handed buyers that are enforcing action, taking it up there. Okay, so watch these areas very, very closely after Wednesday and see if that gives you some clue as to further direction and how this might all go. I want to talk a little bit about this NASDAQ 100 chart because obviously it is a key to everything else, just as much as the S&P is. We call this the other market that we watch very, very closely. I've been talking a little bit recently about how this market has been lagging, and that is the case. Notice that the top line there around the 20,000 level, it's almost 20,700 essentially. That is your all-time high. Look at how much space you have here compared to the S&P. So you're nowhere near it. So this also is something to sort of carry forward in your narrative as we come closer to the Fed, because if the Fed reaction is negative, I would think that it's going to be this index is going to sell off harder. Notice that the same consolidation area that we were talking about in the S&P, right, that's going across, that one was actually going down. We touched upon this in prior programs, and it's not going to take that much selling, I don't think, for the NDX to get back down to where the lower end of that balance area is, right, to retrace this and also get us right back into this bar here. And at the beginning part of this rally, we talked a little bit a moment ago about the sort of emotionality and short covering versus longer term buying. That sort of emotion is greatest and the structure is weakest always on the first day. So that's something to remember, that if the NDX retraces, and it's not going to take much, it's not that far away, into this bar here, correct, which would be Wednesday's bar, keep that in mind, because my opinion here is that these buyers are weakest all the way up through here. I think they're weak buyers, but they are weakest inside of that bar. So again, retracement into that bar about, let's call it 19,180-ish or whatever. Potential for selling, I think, in the NASDAQ accelerates at that level. Time now for the trade of the week, where I look at something that happened usually in weekly options advisory in the hopes that it will be educational for the viewers out there. This week is about two losing trades. Generally, if a trader trades long enough, they are going to definitely experience either downgrades on stocks they are long or some sort of whipsaw action that is going to put their position under pressure. And this week I was hit with both a whipsaw move in one trade in QQQ and also a downgrade in Ulta. So we're going to specifically talk a little bit, like I said, about good loss versus bad loss, just to put a little bit of a psychological spin on it, basically. And again, I hope this is helpful, at least, especially to newer traders. So what do I define good losses versus bad losses? Good losses are simply those losses where you do everything right, but the market doesn't cooperate. So as an example of a good loss would be you purchase a call vertical on a very, very good chart pattern, pull back to 8 EMA or whatever, breakout out of bullish balance, whatever the case may be. You have correct chart reading, and more importantly, you have good location as far as your trade, but the market just doesn't do what it's supposed to do. It either goes up a little, falls back down, or just remains flat and your option goes to zero. That is what I call a good loss, right? A bad loss is when you do the wrong thing at the trade's outset, which means that you either read the chart wrong, your location was poor because you chased, it was the wrong stock at the wrong time, or you weren't paying attention to what the broad market was doing, right? You may have thought that this particular issue was long, but the broad market turned down sharply, or it was already in a downtrend. So why were you looking at stocks to be long, knowing that 85 to 90% stocks will follow the market? So that's what I put into the category of bad loss. And as newer traders, what you want to be doing is to eliminate as many of these bad losses as you can, with the understanding that you will never fully eliminate the good losses. You can do as much work as you can and pretty much get these down to almost zero as your chart reading gets more proficient, your location gets better, and you just basically hone your skills. But this will always happen over time. And like I was saying, I had a couple of those this week that I wanted to show you. So let's move over to the slide here of the snapshot from our P&L performance from Weekly Options Advisory, and I had one in Ulta and one in QQQ. You can see here I want to specifically just talk about this Ulta trade. As I was saying, one was a whipsaw and one was a downgrade. And I want to really focus on the Ulta one because it was the downgrade that just kind of came out of nowhere. Typical risk reversal action that I normally do where I'll be buying some sort of a call structure and selling puts. And in this case, it was the short puts that hurt me a bit because there was a downgrade on the stock overnight that really came out of nowhere that sent what was a very bullish chart pattern much, much lower. So let's take a look at the chart on Ulta to give an idea of how this went down. It's all about this bar here, which I put the horizontal line on, which is September 9th, okay? Notice how strong Ulta moves up towards the downtrend line. And remember, go back to what the S&P 500 and the NASDAQ was doing as Ulta was moving up in this manner. It certainly wasn't this bullish, right? You had this action up here, up here. Now, why was this happening? Because Warren Buffett took a position in the stock. So I knew that we had the tailwind of the Buffett effect, let's call it, the Buffett effect behind it, and we were moving up to there. Well, we took the position there as we got close to the trend line, long calls, short puts like we usually do, and we had our short puts here underneath the low of this session, which to me made perfect sense because whenever there is an expansion of range, especially when that breaks trend to the upside, the low of that bar usually is secure. So this is a very common method that I use where I will put my short puts right under that level. That night, we got a downgrade in the stock, and look what happened. You open here, fell like a stone. Not only did we take out that low, but during the course of the trade, we kind of added a little bit of insult to injury because I didn't think we were going to drop that hard, and I ended up rolling the puts down here to about 357.50 area for the next week. And as you can see, we took that out as well. So I had to just bite the bullet and take the loss on those. And then by the time we ended up actually rallying, obviously hindsight is 2020. Had we done nothing, we'd be fine. But I'm a big believer that if you are short puts, especially naked, and you are moving in the money and you've got plenty of time to expiry, you absolutely positively cannot play the hope card. You have no idea how deep that's going to go. Again, it was on a downgrade on the stock. They were putting a $300 price target on it. Doesn't mean that it would go down to 300, but the news was negative, took the stock much lower, and we had to basically cover. So that caused that. As you can see, then we recovered here. And today was kind of a bullish day, but our long call structure was at 382.50, 387.50, and the best we could do was get about 75 cents for that, so it didn't really help us that much. So not something that I'm happy about, certainly not something to be proud of, but again, these are the types of things that are going to happen in your trading if you trade over a long period of time, remembering this is a marathon, not a sprint, and over the course of that marathon, you are going to be caught in some downgrades or adverse news like that that just comes out of nowhere that every now and then is going to blow your trade out of the water. Time now for the fundamental take with my friend and yours, one of the most colorful personalities on Twitter, Michael Gayed from the Lead Lag Report. And now for the fundamental take, welcoming back to the program, Michael Gayed of the Lead Lag Report. Michael, how are you today?
I am surviving, which is something my father used to always say.
Sounds good, sounds good. So last time we had you on, we were actually talking about markets pre the yen unwinding, carry trade unwinding event. That has since happened. However, since then we have seen continued appreciation in the yen. However, equities have not really responded. So, and especially today is a perfect example. USD JPY hitting the 140 level, which is quite, practically a round turn from where it last went up from. Yet equities advanced all week or most of the week. What's your take on it? Is it over? Is it not a thing anymore? What can we expect?
Yeah, I don't think it's over because I don't think you unwind a 2-decade-long dynamic in 2 trading days, right? From August 3rd to August 5th. Keep in mind, it looks like markets have been ignoring what's going on with Japan more recently, but I keep going back to small caps hold the key. Small caps, Russell 2000, they're not at the reverse carry trade scare highs. It was a pretty big week for them, don't get me wrong. But there's still, I think, some residual divergences that are taking place. Now, I reposted a little bit earlier today. If you look at seasonality, we're entering the period now where September in the next week, that typically is not a good week for markets. We'll see what that means, if seasonality matters or not. But no, I don't think the dynamic is over by a long shot. I think still the risks are very real. The question, of course, as you know, is when.
Let's move over looking in advance to next week. Everybody obviously has all eyes on the Fed on Wednesday. It's going to be the first time we're going to cut in a while. The odds on the CME FedWatch tool have shifted a lot. Early this week, it was literally 80-20. It was 80% chance that we were going to see only a 25 basis point cut. We are now almost dead even. We're at 53 to 47 today of 25 basis points to 50. I want your take on it. What do you think we get, and what are the ramifications for the market?
Sounds like the betting odds are worried about Japan, doesn't it? Based on where the yen is. I mean, isn't that funny how let's go back to the prior point, right? It's like, well, maybe the odds are increasing because there's concern about what's going on with the yen and the implications on the reverse carry trade not being done, and the Fed may be trying to get ahead of that. Look, I put a poll out, and right now it's early, right? But I asked the question, is this going to be like a sell the news event? The Fed's going to cut rates, start this cutting cycle, and will the market instead sell off? Which doesn't have to happen necessarily next week, but as you know, as we all know, usually after the Fed starts to pivot is when you have a bulk of a drawdown take place in stocks. And it's happening again in a seasonally weak period, September to October, where this is taking place. I don't know. The fact that the odds are increasing that much for a 50 basis point cut, which I think would be a mistake, by the way, just from a signaling perspective, tells me that the market is legitimately nervous about something, right? What that thing is, I still think it's Japan, but we'll see.
Yeah. I mean, my personal take, for what it's worth, is it's a lose-lose situation. I don't know if you agree. I feel like the market will not be happy with 25 basis points. And like you were said, 50 basis points signals fear.
Yeah, and I also don't know if it's going to matter that much because the bond market's already cut rates. I mean, you look at the way yields have fallen pretty aggressively. I said, people should be worried about that, right? It's like, who cares what the Fed does? It's already happened, right, in terms of the way the bond market's acted. Now, I will say one thing, which I think is important. If I've been right about anything with this reverse carry trade, and I even argued that the market would have a big run up to pull everybody back in. I didn't think it would go this far, right? Post August 5th. If I've been right about anything, what I've been right about is the idea that the reverse carry trade would bring back the flight to safety dynamics in long duration treasuries. You can very clearly see since August 5th, okay, which was the VIX at 65, when the stock market's down heavy, long duration treasuries up in price, and yields drop. You are starting to see that the Phoenix thing, right? Which is kind of my gimmick now, the flight to safety dynamic.
Right, because the markets are more normalized the way they used to be, what you all really thought,
exactly,
right? That equity is down, there should be flight to safety to bonds, a long bond especially.
Right. And as you know, I'm biased in hoping that happens because my funds live in that world, and that's why they've had such a hard time the last 3 years. But I do think that part of the thesis, I think, is playing out, right? Now, again, if the flight to safety dynamic is because the market is responding to credit stress, which is coming not just from the delinquency side, but also the very fact that we're just talking about the probabilities of a 50 basis point cut are rising, suggests that the market itself is maybe betting on some increased financial stress. Mm-hmm. All that is consistent with a much more normalized environment, which I think for every investor and every trader, we should all want to see desperately.
Okay, let's move on to post-yen carry trade, post-Fed. You have been talking for a while that there is actually a third thing potentially on the horizon, which you have called the main event. And to be more specific, you believe there is potential for a global margin call. So obviously, just as point of explanation, margin call is simply when you own assets, but you have them on leverage, right? Basically, just like any regular person might buy lots of shares of stock, some portion of that is on margin with their broker. If the value of that position marks against you, the broker can obviously call it. That's what's called a margin call. You have been saying that there is potential for some sort of a global margin call on the horizon. Can you explain that a little?
Which, by the way, I think we got a glimpse of with that August 3rd, August 5th move. I mean, that whole move was effectively a margin call. It's the reverse carry trade. It's effectively a margin call. It's the repatriation of leverage back to Japan. And again, I go back to, I don't think that's over by a long shot. And I know people say they're like, oh, you've been saying credit event for 2 years. No, I said at the start of last year, I thought a credit event would happen towards the end of last year. Clearly didn't, but the whole main event thing is just me being dramatic. It's still what I believe is coming, which is a credit event to resync the behavior of junk debt against what the message of small caps has been for some time, right? Small caps are just chopping around like crazy, right? And the fact that we're seeing these downward revisions on unemployment, on the labor side of employment, is comical that people are surprised by this when small caps are where most of the jobs come from and they haven't done anything since, really 2021. So the whole main event thing is basically the credit event. It's the idea that, you're going to have a dislocation. I think what we saw with the reverse carry trade in that 2-day period, there will be aftershocks. I don't think you're going to have something as severe like we saw that in terms of how quickly it happened. It probably would have been more protracted, again, consistent with seasonality. It's not something to fear, It's something you want to buy into after the fact. I keep going back to all these people that say the main event, the credit event, you're a perma bear. No, if you're a long-term investor, you want to see that. You want to buy the dislocations. You want to sell normalcy.
Right. No, absolutely, absolutely. Can you point to, however, before I let you go, any specific event that would trigger? Is there anything that we could even think about that might sort of flip the dominoes over and start tumbling?
Any number of things. I mean, there's China. For all we know, it's like I was asked on a podcast, what could be a black swan? It's like, I don't know, maybe like something happens and it turns out that NVIDIA needs to do some kind of recall on something. And that creates all kinds of problems around the AI trade for a moment. Who knows, right? It's like, I'm just doing a hypothetical scenario. So, but it could be any number of things. I still think Japan is the most likely scenario. The fact that everybody seems to think it's over, to me, it seems bonkers to me that that's the case. Maybe it is. We're in a weird environment.
All right, we shall see. All right, Mike, thank you so much for your time. I do appreciate you coming back on. Obviously, it's Michael Guyad from Lead Lag Report with a little bit of color on maybe what we can expect next week given the Fed, yen, and potential global margin call on the horizon. Thanks again. That's all for this week's show. Thank you so much for spending a little bit of your weekend with me. Before we recap everything that we talked about in this program, I want to give a very sincere thank you to you, the viewers, because last week's program actually set a record for us. Over 27,000 of you watched this show, and it really means a lot to me. That's actually the most viewership that we've gotten since we started the new show here in the new studio after taking a little bit of a break. So again, we appreciate you following the show and plenty more good stuff to come. Remember, if you can, hit the like and subscribe button always and the little bell to be notified when I post new content to the channel. Talking about this particular coming week, it's actually going to be very interesting for me personally because I'm going on vacation. I'm actually taking Monday, Tuesday, and Wednesday off of next week, so I will not be trading ahead of the Fed, and I'm not even sure if I'm actually going to even be able to see the FOMC move on Wednesday, but I do think that it is going to be a doozy. Remember, we've got about an equal chance now of a 25 basis point cut and a 50 basis point cut. If those odds remain the same coming into Wednesday afternoon, to me, what it would tell me is that the volatility should actually be greater and not lesser because the market doesn't know what it's going to get, right? If everybody's kind of thinking half the camp thinks it's a half the camp thinks it's going to be a 50 basis points, we'll see what happens, right? Keep in mind what I talked about on the charts when we were looking at the technical picture here, talking about how the advance right now over the last 3 sessions in that big reversal, to me, has been on poor structure. I know from watching it very, very closely that it was what we call forcing action, okay? It's a lot of short covering, and that type of activity generally doesn't hold if there's a catalyst to bring it back down to the other side. And again, I'm going to be watching for that S&P all-time high level post-Fed to see if we hold that or not, all right? Beyond that, big thank you, of course, to Michael Guyad of LeadLagReport.com, who was able to join us on the program, giving us the fundamental take. I'll be back at it next week. Until then, I wish you good trading and good night.